Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates. Even the holidays sometimes can get as volatile as the markets. If you were hoping for a long weekend, that ship has sailed. But anyway, we love it here at Almus as we enjoy being in the markets. The story has not changed. Yields hitting new cycle highs, a stronger dollar, and pressure on emerging market currencies. Morning, JK. I'm very keen to hear your thoughts on the current situation.
Good morning. Yes, we have one additional working day for the month in view of the changes that the government made, and eventually the regulator has, decided that both days will be working in view of avoiding any disruption in the settlements, etc. Because this is a quarter end and a half year end as well. Now that apart. Coming to the markets, I'm actually watching two races ongoing. One in the economy, race towards partial shutdown of the US government, and the race to the sky in the yields. I mean, the shutdown of the US government is something different from what we were anticipating way back in May. This is more due to the spending bills which are not passed by the Congress. This is not going to result in any inability of a treasury to raise money or meeting its commitments on coupon payments or bond maturity. This is more towards spending on maintaining the government departments, and this can be having a much impact only if it is continued for a long time. Just for a perspective, if there is a slowdown, if there is a shutdown for a week or so, it just shaves off about 0.1% of the annualized GDP. But if happens to be a couple of months of shutdown, then it will be a 1% drop in the GDP. But it's all up to the politicians, how they want to take it, and what they will be okay in the face of the elections that they are facing. Now, if you look at the yields, we saw another volatile day. Yield started slightly lower, but the dip was eagerly sold into, or rather, dip was easily latched onto by selling bonds, which the yields, rallied strongly to have another new high close. From the low of the day, 30-year yield rallied 12 basis points, and 10s gained a whopping 15 basis points. And reports indicate huge number of sellers with high volume and block sales, all indicative of fears of even higher yields and possibly long books bleeding, adding to the concerns. Minneapolis Fed President Neil Kashkari said on Wednesday, it's not clear yet whether the US central bank is finished raising rates, and ample evidence of ongoing economic strength could keep the prospects of another hike quite open. If you look at the overall markets, it was a remarkable day, of course. Long bond yields rose to 16-year high, dollar hit highest level since November 22, and the crude oil prices hit a 10-month high. And all of this is a pain trade, as markets have not been positioned for such massive moves in the short period. Oil prices in particular is a headache for policy makers, as well as it raises the prospects of fresh uptick in inflation. The prices surged after the US crude stocks fell more than expected, adding to worries of tight global supplies. Stockpiles at the Cushing, it is the place where the oil is stored in Oklahoma, this state of US. The delivery point for US stocks fell by 940,000 barrels from the previous week to 22 million barrels, and that is the lowest since July 22. No wonder we have Brent now trading closer to 98 and very, very ominously close to the 100 mark. Coming to the stock markets, we had a Nasdaq which almost lost 10% from the July peak of 1,446. S&P 500 has lost 8%, and Dow Jones a more modest 6.5% from their highs of this year. Now, most of it is triggered by a higher for longer theme of Fed, prospect of another rate hike, and a likely partial shutdown of the government, even as politicians fail to reach a deal on the passage of spending bills. ideally we should get a pullback from these slightly oversold levels. And yesterday's price action did show some value buying emerging, but we do not have any relief in any of the headwinds that the economy and the investors are facing. Now on the currencies, the USD yen inched closer to a crucial 150 mark, above which is widely expected to see intervention from Bank of Japan. Of course, central banks always want to surprise the markets to have maximum impact, and hence either they allow a overshoot or come in much earlier than the levels at which they are anticipated. In any case, the undervalued yen needs really some boost, as even carry trade should be reaching its limit soon, and anything beyond will be a bubble, raising risks of disorderly reversal. And on the euro, of course, we did almost touch the year's low at 1.0483. Sterling performed slightly better despite all the bad news that is surrounding it. Yes, we have had 11th week of rise in the dollar indexes. It continues to baffle the technical watchers, but that's what it is. The trend is your friend. So you need to contend with more strength in the dollar so long as the factors in its favor are working out. On the rupee, it stayed in one of the narrowest ranges yesterday. Of course, closest to the all-time lows, thanks to central bank using its war chest to protect it from breaking into new lows. What may also be holding the market is an expectation that the FTSE Russell may announce their decision about including India in their bond index today. However, even that is mostly a discounted factor, and the market's undertone is one of a soft rupee eventually. It's not conceivable that the intervention continues much longer if the current level of demand for dollar is sustained, and in the face of many factors working against it. I expect the rupee to catch up with other currencies' weakness in the coming months. Data calendar gets thick today and tomorrow. We have the Q2 GDP release final estimate and the weekly jobless claims today, and GDP is expected to remain at a healthy 2.1%, and which compares very, very good, relative to other major Western economies. Jobless claims is expected to be, presenting a weak, strong, strong and healthy jobs market. Pending home sales report is also expected today. Tomorrow we will have the all-important report on the PCE core inflation, which will be important for Fed policy. We also have a speech by Powell at an event which is not so economically important or on any policy matter, but it's a minor event where still the market would be keen to look at any hints of monetary policy thoughts or new thoughts that are emerging among the Fed based on the developments in the recent days. So with an additional day of trading for the month, we have more volatility ahead. Of course, that tomorrow the banks will be markets will be open, but possibly the branches will not be open. So that can be a thin day as far as the flows are concerned, but still the rupee trades will be on. Thank you.
Thank you, JK. And of course, now the focus will be on the US government shutdown. Now, this is more due to the spending bills not being passed by the Congress, but it will not hamper the Treasury's ability to issue new papers or pay interest on existing debt. Another factor to watch out for is oil prices. They continue to rise, raising fresh concerns for inflation across the globe. And for rupee, we continue to trade in a very narrow range. FTSE might include Indian bonds in their index, but as of now, it seems well discounted. That's it from us today. Tune in tomorrow for the latest in the financial markets. Thanks for listening.